Hi everyone, this is Skylar Bus, Client Service Associate at Zhang Financial. Today, I sit down with Lynn again to discuss some of the questions from our initial episode. Discussing fiduciary standards and how financial firms are held to those can be quite complicated. But today, we'll take a closer look at an example of these moving parts in action. Lynn, in our last podcast, you discussed the difference between fiduciary and best interest. You also mentioned that even when an advisor is upheld to that fiduciary standard, it is still important for the client to do their due diligence as there can be many conflicts of interest. Can you explain a little bit more about that?
Absolutely, Skylar. This is actually a very confusing concept. So I think it's better explained with an example. So I think what I'm going to do today is to use the example of Fidelity. So Fidelity offers its services to retail advisory services to retail clients through Fidelity Personal and Workplace Advisors LLC. So you can go to, as explained last time, you can go to the SEC's website and find out the regulatory filings of that company, of that entity, and find out their ADV, their ADV Part 2, and then also the Form CRS. So we'll take the easiest one, Form CRS, Client Relationship Summary. It's like, as I explained the last time, that the Client Relationship Summary has a set of standard questions, and normally it's either 1 page or 2 pages. So it's not that hard to read. You would think it's not that hard to read, but there are a lot of terminologies and bottom line, it's written by attorneys, right? So it can't be that easy to understand. But the SEC does try to make it like more straightforward questions. I personally think that of all the questions, some of them, it's a standard set of questions that has to be answered by every investment firm that's registered with the SEC. And of all the questions, I think one that is the most important is, what are your legal obligations to me when acting as my investment advisor? How else does your firm make money? And what conflicts of interest do you have, right? It does not go more straightforward than that. What conflicts of interest do you have? So in Fidelity, in the ADV, they said, when we act as your investment advisor, we have to act in your best interest and not put our interest ahead of yours. So you say, wow, great, right? We're not going to put your interest ahead of yours. But wait, read forward. At the same time, the way we make money creates some conflicts with your interests. So there's the part that becomes juicy. So one, it says, FPWA or its affiliates typically earn more when you invest in a product that we or one of our affiliates advise, manage, or sponsor, such as Fidelity Mutual Fund or ETP. This creates an incentive for us and our affiliates to recommend and invest your assets in our investment products over those offered by another company. So basically, it's a conflict of interest created by proprietary products.
Wow, so is this conflict of interest very common within these firms?
Yes, it's very common. If you would go, for instance, read Merrill Lynch's, and it's all going to be the same. We offer proprietary products, and therefore we have incentive to sell our proprietary products over any other product companies. So, and another one is the second one, FPWA, which is Fidelity, the entity, or its affiliates, earn more on your investments in some third-party funds and ETPs, and therefore have an incentive to recommend and invest your assets in these funds and ETPs over others. So there is another one. What does that mean? That means they take kickbacks from some fund companies. Therefore, they have an incentive to invest your money into these funds that give them kickbacks over other funds that don't give them kickbacks. That's the layman language.
So you would think it's really important for the clients to be aware of this before they trust any of their advisor's recommendations, correct?
Correct. So just like what the CRS says, you say that yes, they should have put my interest first, but they have incentive to not put my interest first. So it's hard to digest, but you just have to do your due diligence and think twice before you accept a recommendation from your advisor. There's another one. Our investment advisory programs charge different fees. This creates an incentive, here's the word incentive again, for us or our affiliates to recommend advisory programs that pay us, our affiliates, higher fees over other programs. So in other words, you have to think twice when you listen to the advisor when they recommend you, one, the program first, make sure you got the right program. And two, the products, make sure that that's the right product because they have incentive to put you in more expensive programs and more expensive products.
So you're saying the firm has incentives. Does the client-facing advisor also have incentives?
Yes, so read on the form CRS. There is another question. Again, I give SEC credit. They do want the firms to make disclosures to you, but that's about what they can do. It's up to the clients to read it. So if you read further into the form CRS, it said, how do your financial professionals make money? Now that's a client-facing advisors, right? What you're asking. In Fidelity's, again, that form CRS, it said, our representatives have an incentive to recommend that you select a program or product that pays them more compensation than those that will pay them less. So they have incentive and the firm has incentive. Typically what you will see is the firm has incentive. Therefore, they will make sure to structure the employees' compensation, the client-facing advisors' compensation in a way that the advisor's interest can be consistent with that of the companies, but not necessarily with that of the clients.
That's really insightful. So people really need to read those CRSs very carefully.
Yeah, absolutely. I mean, you're not going to see the Fidelity that has those big bold letters of our conflicts of interest on the first page of their website. So clients do need to do their due diligence carefully by themselves. I want to give you actually, for that part, I'm going to share with you some interesting cases. So in October of 2018, Fidelity was sued by its actually own employees. And the Fidelity Retirement Savings Plan, according to the suit, had nearly 15 billion, it's a B in assets, and covered 58,000 participants. So the plaintiffs alleged that Fidelity used the plan as an opportunity, its own plan, retirement plan for its own employees, to promote Fidelity's mutual fund business at the expense of the plan and its participants. So in late March of 2021, the judge of the U.S. District Court for the District of Massachusetts ruled that in many things that Fidelity does have the burden to prove that it does not fail to monitor the proprietary product use in its own retirement plan. So The end of the story is Fidelity settled by $28 million, $28.5 million, the case.
Well, I heard Fidelity has some zero-cost mutual funds.
Yes, they do. And there are quite a bit of media exposures for those zero-cost mutual funds. But as of August 31st, 2021, I have not checked recently, but as of August 31st, 2021, based on Fidelity's own website, it has numbers to show the market cap of all the Fidelity mutual fund assets at Fidelity. So the zero-cost mutual funds, guess what's the percentage of it, of all the Fidelity mutual funds?
No, what?
As of August 31st. It's a whopping 0.59%.
Oh my gosh.
Interesting, is it? I'm not going to make any comments. So, but the zero-cost mutual funds is, as of August 2021, is 0.59% of all the Fidelity's mutual funds. So just to tell you how popular that is. So I hope this example actually illustrates a little bit further into when I stated last time that even though the firms should put clients' interest first, but somehow they create by themselves those conflicts of interest that creates incentive for them not to put clients' interest first. So therefore, the burden of due diligence is always on the investor themselves.
Well, thank you for taking the time out of your day, Lynn, to clarify some of those questions from our last podcast on this topic. I really appreciate it.
You're very welcome, Skylar. And this is not the first time and it won't be the last time we discuss on this topic because it is important topic and probably one of the most important topics for people to ensure that they can have financial success.
That's all for this episode of the Zhang Financial Podcast. If you have any lingering questions for Charles, Lynn, or the Zhang Financial team, please feel free to reach out to podcast@zhanefinancial.com. It's also listed in our show notes. We'll be back on Monday where we'll provide another market outlook on the upcoming week. Until then,